To remain updated with the latest business news, click on the bell icon.
Hello and welcome to this pre-budget market special, Business Today. I'm Udayan Mukherjee, with me is Abha Bakaya. And on our guest today, a very special guest, a veteran of many bull markets and a survivor of many bear markets as well, the one and only Ramesh Damani. But Ramesh, very good to see you after a long time. But I must start by asking you how you're looking forward to 2022, because, after many years, this easy global money, which has been such a big underpinning of this bull run, is probably on its way out. So how do you see markets doing in the backdrop of that in 2022 as we learn to deal with rising interest rates after so long?
Thanks, Udayan. Thank you for inviting me, and it's great to be back on with you after so many years, and Happy New Year to Abha too. Udayan, I think 2021, as you pointed out, was actually very good for our wealth, but very poor for our health. But I think 2022 promises to be good and bountiful for our health. I think we're now at the end stage of this pandemic. It's going to become endemic, I feel, and also good for markets. I personally believe that we enter this week has been a very good week for the Wall Street, the best start in 20 years. And I think the rest of the year will be pretty positive too. I think we're moving to a sweet spot for India. And I remain, optimistic. I think the bull market that started in 2019 is well and alive and will probably take us a lot higher.
So you're in the camp which believes that we are going to make a new high this year, despite predictions of all this volatility and inflation fears, etc. You think we'll take out that nifty high and make a significantly higher peak this year?
Almost certainly, I feel that, Udayan. Let me just put the intellectual case for this bull market to you, and then we'll talk about inflation if you want. Udayan, the two pillars or the two poles of the global economy have been, of course, US and China, and both of the last decade have added a lot of heft to the markets. But they're now moving in slightly different directions. The Chinese want what they call common prosperity, which sometimes means cutting down their businesses to size. And the US is starting as a great socialist experiment, like the Great Society of the 60s under Joe Biden. In any case, it's under some sort of political gridlock going on there. But what we are seeing in India is perhaps, someone rightly pointed out that China made the physical world, India will make the digital world. So I think we have a unique opportunity. The reform process that has started in India, the cutting of corporate tax rates, the PLI, the disinvestment, I think will all add up to our place in the sun. And I believe that the smart money in the Wall Street has kind of figured it out, that if we, do our act right and get our act right, this could be a long and sustaining bull market that we've talked about for maybe 30 years, but this could be the real McCoy, if you believe, at this time. Now, here's the intellectual case again that I think Larry Summers put it best when I heard him. He said that if India can grow at 8%, and we're growing at about 9% right now from albeit a low base, if we can grow at 8%, that in effect means that in a generation, in 20 years, we'll quadruple the size of the Indian economy. So we'll go from 2.5 trillion to 10 trillion people by the time India turns 100. So this is a great chance for us in the sun. There's a crack open because of what's happening in the world, and India being a large economy can take advantage of that. And I do see signs that we are taking advantage of that.
So just to bring it back to the budget, is there a lot that needs to be done or you really expect to happen? Because a lot has happened already. I mean, I don't think the corporate sector has had it so good in terms of taxes ever. So are there expectations from the finance minister, or I think stock markets are happy if there is status quo and not much is done in this budget?
Udayan, budget is obviously a big media event, and it used to be a terribly important event for the Wall Street. And its importance is diminished. Of course, there'll be, as the budget date rolls around, people will ask what will be the fiscal deficit, will there be an inheritance tax? All these potpourri of demands and counter demands will go on. But the best analysis I read of the budget for the intellectual framework was by an editorial by Nainan in the Business Standard in a pink paper, when he said that India's tax to GDP ratio now, not tax to debt to GDP ratio, has going from 50, 60 to almost 70, 80% now. And interest as a percentage of our budget is now going from 34% to 41%. Tax to GDP collection remains at about 10% over the last decade. So he says if India needs to raise new revenue, which of course we need to do, how do we do that? We can do it either by expanding the revenue base or increasing taxes. And I hope this budget will lay the intellectual framework that we have tried socialism, unlike what China is trying now or what the US is trying now. It doesn't work. We need to make a bigger pie. And the budget will, lay a lot more emphasis on making a bigger pie. So then we can distribute the money more equally. So I think the answer to the budget would lie in, as we always do in the government's, how it handles the fiscal picture. Will the deficit come back from 6.8 to 6%? And what are the streams to raise more revenue? Because clearly the government has had buoyant tax collections this year, but there will also be a lot of expenditure on behalf of pandemic. So I think in the budget, I would look at those two numbers. What percentage is being taken away by interest rates, and what is the government doing to fall the revenue shortfall that we seem to consistently face. I think the other things are, par for the course. Some are give it, some take it. As long as they don't come with the inheritance tax, I don't think the market will be too disappointed.
Okay. Mr. Damani, you've been, very big on the kind of capex that you anticipate now going forward. Firstly, I want to get a sense of your thought process here as we enter into new year of investing, but also what more can we see from the government in order to really incentivize or to see that actually happen on ground?
Well, the capex is, as you know, about front-loaded by the government itself. I think there's some capex going on by private sector, perhaps in cement, in petrochemicals. There is solar energy. There is some capex in there. The big problem in India, as Udayan pointed out in his earlier question, has been inflation, and it's now a global phenomena. But the Fed, has come out with very stern statements recently saying that they're going to fight inflation because that is the mandate. They can't seem to be sucking their thumbs when inflation is at 6.8%. But here's a couple of things that I'll put for your observation, Abba. First, that the US 10-year Treasury, while it's gone up recently, is still at 1.8, while inflation is 6%. And the inflation-protected Treasuries at a 3% premium. So whatever has been going on, at least the global markets don't expect inflation to be very high or very violent over the next few years. So while the Fed is saying it's not transitory, I believe they have to say that. They have no other choice. I personally believe that inflation will come down. The real problems in supply bottleneck chains, 90% of global traffic is carried by the sea and 9 carriers control that. So I think those will sort itself out maybe in a year's time or 6 months' time. I think inflation will remain benign. And here's the other thing that the market doesn't seem to anticipate. I think China will continue to fight a zero COVID policy. The reason they will do that is because first they have the Winter Olympics. So they want to keep a spread of Omicron down to the minimal level. And secondly, they have a very important National Party Congress in the last quarter, where Xi Jinping will again be re-elected for life. Now, they want to keep Omicron, subdued up to that point and say they managed it well. So that means that China will have huge amount of investable surpluses, which they'll invest in the T-bill market in America. So interest rates will remain low and inflation will become more benign. So I think there is reason to be optimistic about global equities, but more reason to be optimistic about Indian equities in 2022.
You are a keen student of disinvestment, Ramesh, and you've held very strong views about it in the past. What's your thought on how this whole divestment process is moving along? Because Air India was a big tick in the box, but BPCL has really dragged its feet. What are your expectations from the finance minister this year in terms of the divestment calendar, and how much will actually get done?
Well, I'll take it as two questions, Udayan. What about the disinvestment process and what about the public sector units? Because as you know, you and I have talked many times previously about the public sector disinvestment policy and the investment merits of that. And frankly, I'm a little bit tired of hearing common friends come and badmouth the PSUs over a period of time. But here's my couple of points, Udayan, for what they're worth. First, any investment is forward-looking, not backward-looking. But even let's look backward. Let's say, what have PSUs done? And I'm very tired of analysts coming on television and saying, oh my God, look at the PSU indexes underperformed for 10 years. But if I included Infosys and Wipro along with DSQ and Silverline, even tech would not have a great performance. You have to look at these stocks individually rather than lump sum in PSU because they're quite diversified base within the PSU. But even let's take your case, let's look back. I own two stocks which I've talked to you about many times in our previous meetings, Bharat Electronics and Bharat Earth Movers. These stocks are 100, 150x over the last 10, 20 years, which is a CAGR of about 24, 25%. And that is without dividends. So these are exceptionally good companies. The trick is to find the good ones. They are not really all bad PSUs, all good PSUs. They're good and bad PSUs. So I think currently there's some lot of attractively priced PSUs that I look at. Coming back to your specific question of disinvestment, of course, it's been very slow. Of course, it's been very tedious, and but that's the nature of the body politic in India. I'm surprised, given the fact that the Prime Minister itself is behind the program, given the fact that he has a stable mandate in Parliament, given the fact that now you raise oil prices and no one even raises a red flag somewhere. It has been so slow. But I mean, I don't know. I wish the Prime Minister would step in and make sure the LIC does well. My one suggestion to the Prime Minister's office at this time is that hire some smart merchant bankers. Don't pay them, $100 or $1,000 to give to the lowest cost bidder. Tell someone that you will be rewarded based on the market capitalization you create for these companies. I think these are very ripe value stocks. The market is moving towards valuations. And I think I'm hopeful that disinvestment and PSU investment will look much better in the next 3 to 5 years than they've looked in the last 3 to 5 years.
Well, let's hope so. But I also want to ask you about this other thing that you mentioned in terms of while listing out the reforms from the government, which is the PLI scheme. But, if it succeeds, it will be a big thing. But, different people seem to be playing it differently from a stock market perspective. I mean, how have you added this theme or woven this theme into your portfolio selection? Are there attractive candidates in the stock market which you can pick to place this theme over the next 4 or 5 years?
Udayan, I think the way I think about this scheme is not necessarily in terms of PLI, but in terms of the China plus one policy that is now seems to be, in the minds of a lot of global thinkers. And I tend to believe that given the supply shocks that the world has had, and given the fact that China is, at dagger hold over the Taiwan Straits, the world is looking for alternative supplies. And India is, because of its manufacturing capacity, its excellence of engineers, software people, whatever, plays right into that strength. So while I've never really been a big buyer of the manufacturing part in India's stock, I prefer more of technology and things like that. I think this will give a fill up to manufacturing in India. And I think, there will be plenty of companies doing greenfield projects in cement, petrochemicals, plastics, solar energy. And, you will find your opportunities out there. But the thing that I'm focusing on more pertinently is this China plus one policy, which I think is quite, a major change that will take place. Here's the thing that is important in this policy also. There's an analyst called Balaji Subramanian who pointed out that while I mentioned that, but the point is that while Saudi Arabia oil is so important to Saudi Arabia, India's software exports have now crossed Saudi Arabia's oil exports. So that's a huge paradigm shift in India. So one part of the market portfolio will obviously be, technology. The other parts will be specific stocks that you might pick from time to time. I particularly don't, play the manufacturing part in India.
Okay, not so much manufacturing, but Mr. Damani, you have been looking at some pockets of the market which you feel are now going to recover and are available fairly cheap, where perhaps we could either see benefits of the economic recovery or further government spending. Talk us through some of those pockets that you feel are pertinent to the India growth story now going forward.
Abha, just in terms of, say, you ask me, how do I construct a portfolio today in India? Not necessarily what my portfolio is, but what you construct a portfolio. I think, as I said, digitization is a big story. So you put 30% into high cap, market cap technology companies. These guys, Udayan and I were together perhaps when Infosys got listed in the NASDAQ. And 20 years later, there is still a lot of steam left in the Indian technology play. So we put 30% there. I would personally put 30% in the public sector stocks, irrespective of divestment. I think there are just enough opportunities in some of the newly listed rail and defense stocks. Like I pointed out to you, there's been extraordinary returns in some PSUs in the past, which are forgotten because people tend to lump all the PSUs together. And a lot of commodity PSUs, which also probably are attractive. So that leaves us about 40%. You put a little bit in telecom, a little bit in capital expenditure, a little bit in special situations, which, I like to pick up stocks from bottom up. So, there are plenty of opportunities. As I think one of our friends said, that sometimes I feel I'm running out of money, not ideas, because the market still seems right for stock picking at this point.
You mentioned IT, Ramesh, and you've been a tech watcher for many years. But what of, you can only play so much digital listed in India because there are only a handful of stocks listed yet. But of the crop which has got listed, the Nykaa, Zomato, Paytm, Policy Bazaars, have you found interesting ideas to include in your portfolio at these kind of valuations?
Interesting question, Udayan. Not yet. The food delivery companies I find extraordinary businesses. It's just the valuation, I'm still not comfortable. If you look at New Year's, they've delivered maybe 2 crore orders. It's an extraordinary job they do, extraordinary service they provide. Maybe the valuation will correct and give me a buying opportunity in these. Some of the other ones that are listed, strike me as being a bit too overrich, a bit too fanciful for their prospects. So I've avoided them. Among the newest listings in the digital space, as you will, the only ones that attract me are the food delivery companies because I think they do an extraordinary job. It's just that it's important to get the market cap right for these companies, Udayan. People tell me that, maybe those people who missed the tech boom are going to miss this new age boom. And I always like to refresh their memory and tell them that Infosys went public in 93. Its market cap was 30 crores, $10 million US perhaps, 30 crores. Now we're struggling with market caps which are in 6 lakh, in 6-digit numbers. So I'm not necessarily comfortable buying these, but at some point, some of them will be attractive businesses.
The other part I want to ask you about is, of the 40% in your portfolio construct, non-IT, non-PSU, is the whole area related to consumption? Because in the past, you have included stocks from the liquor space, from the poultry space, and maybe from even the quick service restaurant space as well, which are consumption fed. Are you still bullish on those names? And do you think post-COVID, you can make a case out for some of these names as well?
Absolutely. And I still own them, what I had 10 years back in terms of consumption. In fact, as part of the portfolio, I rarely look at, because if you are an Indian and you don't believe in the consumption story, there's very little else you can believe in. So yes, I have a lot of the quick service restaurants in there. I have a lot of the consumer companies like Lever and Godrej, just to take a few names, but which haven't sold yet. I think telecoms are increasingly being looked upon as consumer staples. I think we read the intelligence from Wall Street. A lot of the telecom companies are coming into your consumer-like attributes behavior. So I think it's a good time to look at that company, those companies also. I think we're getting very good messages from the telecom companies. So I would include that in any basket, yes.
Mr. Damani, you are a veteran of the stock markets. We have spoken with you time and again over the years. And, particularly given the kind of cycle that we've seen when COVID first hit and then the way the markets bounced back, I'd love for you to share with some of our viewers, and there are just so many new investors in the markets today, really how they should prepare to ride out some of these waves and, just reinforce perhaps your belief in the equity markets as a investment class of choice at the moment.
Sure, Abha. If the truth be told, it's been, pretty humbling for me. In March 20, when the pandemic came full force, front and center, like many of my compatriots, I also panicked. It was only in September, October that I realized the market was telling a different story and that I turned bullish. So the first 6 months I was bearish as the next guy. So I've been late convert to this bull market. But, in some other media interview, someone asked me, Ramesh, which has been your best trade? What has been your best year? And my answer to the question was that, I'm a compounder. I believe in the theory of compounding, and you can start, Abba, with almost any amount of money. And that is what I mean to tell your younger investors and people who are new to investing, is that you find a great business and you stick with that and you compound that over 30 years. Almost any amount of money becomes a very serious amount of money at the end of 30 years. So this is a young country. And to add to another point, are the investment opportunities as good in the next 20 years as they were in the last 20? I would say by all means, I'll thumb the table and say they're as good as they are in the next 20 years. So the thing is to just find good businesses and compound. I may not have found, some of the great stocks of the last 10 years, or, may have had some bad picks also. But, if you stuck to good businesses and they compounded for you, you did extraordinarily well in the last 30 years. And I think the next 20 years are as exciting to me. Here's the stat that we should remember. India in the 90s was a basket case. Now our software industry produces more revenue than the oil industry of Saudi Arabia. That's how far we've come as a nation. So I would remain very optimistic over the next 20 years. There will be volatility. Of course, there will be volatility and markets will go up and down. But if my life is one of testament, it's that if you buy great businesses and you stick with them, you'll end up with a very happy result.
My last question, Ramesh, is to try and narrow this time frame a little bit, because you and I are both, not Abha, but you and I are both getting along. So 30 years, I don't know whether either of us are going to be around to enjoy the fruits of this bull run that you're talking about. So can you tell me a little bit about the next 10 years? We are most likely to be both around for 10 years at least. Now, could this be India's decade, 2020 to 2030? Because last 10 years, while people have made money, it's not been a great time for the stock market. You can't say it's like 2003 to 2008. Could the next 10 years be really different?
As our common friend Rakesh is very fond of saying that apna time aayega nahi, apna time aa gaya hai. And I think I once agree with him. I think you're right. I would be optimistic over the next 10 years. Will there be corrections? Can the market correct tomorrow? It just corrected 10% last month. Can it correct again? Of course it will correct. I have no doubt about that. But as I've told you, there's a crack in the door of the global market. And India is well positioned to take advantage of this crack. And from talking to my friends and talking to the intelligence on the Wall Street, there's a belief that because we have a stable government, the government realizes we have to grow the economic pie. And we can see that those start of changes happening, that I would remain bullish and I would remain invested. What are the things that can go wrong in the global market? The global flashpoint now is the semiconductor industry. So the Taiwan Straits, there could be a huge problem there. Global interest rates go out of whack. I don't really understand global interest rates, but global interest rates are the clearing price of capitalism society. So if something clearly untoward happens in global interest rates, I don't think we're going to survive independently on the Wall Street. But, as you always know, then we always climb a wall of worries. So 30 years have taught me to be bullish. So I don't see why I should not be bullish in the next 10 years, particularly when I think that the Indian body politic is moving in the right direction.
On that note, Ramesh, we will thank you and wish you a very, very great year ahead, as always. Thank you very much. It's always good to hear your thoughts and very good to talk to you after a long time, my friend.
My pleasure, Udayan. My pleasure, Abha. Thank you so much.
Thank you, Mr. Damani. Thank you.
If you like the video, do like, comment, share and subscribe.